All right. Hello, everybody, and welcome to a video where I'm going to teach you how to do a little bit of work on the ledger. This one will focus on getting your pre-start plan information properly recorded. So the first thing you need to do is make sure you have your pre-start plan filled in correctly, including your credit limit. Let's say I started with a $230,000 credit limit. All right, we can actually right off the bat enter that into our ledger. So why don't we try and do that? So this is going to be in January, and I'm going to call this my line of credit, LOC, and it's my first transaction that's using my line of credit. So I'm going to call it 01. All right, CCIDs here are just going to be useful indicators. You try to, I don't know, make an acronym for the transaction that you're recording. So I'm recording my line of credit. I've got two different accounts for it. One starts with a 4 and one starts with a 5. Our 4 account is going to be a future asset. If you remember our asset liability equity equation, a 4 is a future asset. So I'm going to get rid of this future asset and turn it into cash. So, sorry, I'm going to get myself this future asset to turn into cash. So I'm going to debit, because debits increase assets, make them go up, 230,000 into my line of credit account, 4101. You'll notice right now it says it's not balanced. All right, that's okay. Double entry means we have to do it all again. So I'm going to continue on in January, just copy and paste that or drag that down and copy and paste this down. If you try to drag it, sometimes it changes numbers on you. So I have my debit. I need a matching credit now. So line of credit means I have this amount now in a future available account. And that came from this future liability account that I might have to pay back. Also my line of credit, but you'll see that it starts with a 5. Account starting with 4 is a potential future revenue or asset. Account starting with 5 is a potential future liability. So I might in the future have to pay back the bank $230,000 if I do ever take out a loan from my line of credit. So your line of credit is, sort of like your credit score, how much the bank has approved for you and will trust you with. So you could now go and take out a $230,000 loan. And that's exactly what I would do. I'm going to go in and make sure to take out my loan here, enter the Google form, and take the full amount out. And there's a ledger entry for that as well. It's also going to be in January. So I'm going to leave a little gap. I like to leave space in my ledger so it's easier to read later. You don't have to. That's just something that I like to do. And here I'm going to now take money out of my line of credit. So it still is going to fall under this line of credit CCID. It's still in my first month, so that didn't really change. And I can copy and paste it down because I know I'm going to use it again. So now we ask ourselves, all right, what happens when I take out this loan? Well, I am going to be, you got to kind of think chronologically. It's not super important to be exactly chronological in this course, but in the real world as an accountant, you want to make sure everything happens in the correct order, the correct timeline. So I am first going to get rid of this potential future line of credit. So my line of credit asset that I might have, I'm going to turn into an asset that I actually have. So I'm going to take out my $230,000 from my line of credit. So I credit this that decreases how much I could potentially have in the future, because now I actually have it as cash. So I call the bank, I tell them I want to take out this loan for $230,000. They're going to start by giving me the cash. So my line of credit has now actually been fully withdrawn. All right, and I have the cash, but I'm actually not done yet, because this isn't free money. This is stuff that I need to pay back. So I need to go in and actually take out this loan. So I'm going to copy and paste this down, and I'm going to think ahead and actually copy and paste it into the next 2 lines, because we are working with the double entry system. So as I take out the loan, what happens? Well, I get a bill. That is a liability. So I'm going to credit this liability account starting with a 2 for 200, and you guessed it, 30,000, the same number again. So I have this bill that I need to pay. All right, and I need to balance it here too. So that's actually money that I owe now. So I need to actually balance my future potential liability and turn it into a present liability. So I'm going to get rid of this line of credit future account, and I'm going to turn it into a present account. So I'm going to debit that liability account, 230,000. All right, so that loan went from a future account starting with a 5, all right, into this current account. So if you wanted to change the order of that, I think it's more chronological to first have your future line of credit liability taken away, and then the loan is given to you. All right, that's acceptable too. All right, but I'm going to say that, well, actually first the bank gives me the loan, and now I can no longer take out that $230,000 liability in the future, because I already did. It's now a present loan. And you'll see that everything is nice and balanced. All right, and we can also look here on our chart of accounts to make sure that everything is looking good too. Some things that we want to keep in mind from this section is that our assets, anything starting with 1, have to be positive. So all I've got so far is this cash in my assets. And our liabilities, starting with a 2, anything that starts with the number 2 here, is also needing to be positive. That's our liability. So that's good so far. Equity, anything that starts with a 3, can, however, be negative. All right, so far I haven't affected my equity though. My net worth is just 0 right now. All I've done is taken out a loan. All right, I haven't made any money or lost any money until I actually need to pay interest on this loan. All right, so I'm going to do that next. All right, in our summary sheet, when we take out our loan, it'll tell us how much interest we owe. So in January, right, before I even started anything, took out my full $230,000 loan. And it's really important to put that into your summary sheet. All right, loans taken is $230,000. All right, also really important every month on the summary sheet is to enter your interest rate. And my first month's interest rate is 5%. And there we go. It automatically tells me how much interest I have due at the end of the month. So I'm going to do this actually right at the start of the month. The bank is going to give me this loan. They're also going to give me a bill for how much interest I owe at the end of the month. So we're going to change our code a little bit. So this is still in January, so I can keep the date the same. But I'm going to now call this my interest payment. All right, in my first month, interest payment 01. So what accounts are affected? Well, there is actually an account called your interest. So let's look at that. Interest payments starts with a 2. So it's a bill that the bank is giving me. When they give me the bill, my liability account should go up. And according to our asset liability equity equation, that means that we go up here. Credit is going to make our liability increase. So I'm going to put the full interest amount due, $11,500, as a credit. That's a bill that I have to pay the bank now. All right, so they give me the bill. You might think, okay, then I just pay the bill. There's actually a step before that. So they're going to give me the bill, and this is essentially money that I'm spending that isn't gaining me anything. This is kind of like a penalty or a charge to use the bank's money. So that actually is going to look like a loss on my ledger. So that's going to be an additional accumulated loss. You'll notice that this starts with a number 3, which means it's an equity account. All right, and my net worth is another word for your equity, is going to go down by the amount that I need to pay the bank. My net worth is now going to be negative. All right, so I'm going to balance this interest payment account with this accumulated loss account. All right, so we're back to balanced. But you'll notice when I take a look at my chart of accounts here, I now have negative equity. My total equity is negative. So not off to a great start, but that's okay. I haven't actually started. This is just me taking out my loan. All right, so right from here, you could jump into the next section, or you can actually follow the conservative GAAP principle of paying your interest right at the start of the month. It's not due till the end of the month, and maybe you don't actually pay it till the end of the month, but we're going to record it at the start of the month here. So we're going to get rid of our cash and actually pay this off in January, and that's going to be another 2 lines. So I'll copy and paste that, and I'm going to get rid of some cash. Cash is an asset starting with 1. So when I credit it, sorry, 11,500, that reduces how much cash I now have. And you can see that it went down from 230,000 to 218,000. All right, what do I balance that with? Well, I need a matching debit. All right, and that is going to be my interest payments, which is a bill that I have to pay, is now being paid. So I get rid of my cash, and I also get rid of the bill. That bill is paid. And since it was a liability account, by debiting it, I'm getting rid of it. All right, and hopefully you remember the asset liability equity equation. All right, if you don't, take a look at your notes, make a little cheat sheet for yourself. I could even just quickly write it here for you. We have our, here, it's there for you. Asset equals equity plus liability. Assets go up when they're debited, equity goes up when it's credited, liability goes up when it's credited. If you don't debit an asset, but instead credit it, it will go down. All right, so there's a little reminder for yourself too. Whenever you're wondering, well, do I debit or do I credit? Well, ask yourself, what account is it in? And is my dollar amount going up or is it going down? All right, we have now paid our interest, and we can hop into the next part of our pre-start plan, recording all of our free gift startup factories, as well as the 2 or however many you choose to buy. So I'm going to build or be given a free agriculture factory, along with 2 free agriculture RMUs and 1 free agriculture FIU. And as soon as you select these in the pre-start plan, it will populate your summary sheet with those as well. So first, let's look at our free standard factories for agriculture. So again, still in January. So copy that down here. And I'm going to change this now to my gifts. And we're in January, so I'll call it gift 01. All right, that gift is the gift of a standard factory. So we can scroll through here, or we can just start typing in our box. We want agriculture. There's lots of different agriculture, but I'm focused on my standard factory here. All right, so I was gifted one standard factory, which is an asset, and I gained it, so it went up. My assets went up in value, so that needs to be a debit, right? Debits increase assets. How much do I get dollar-wise, though? That's where the price info sheet will help you out. The construction cost of a agriculture standard factory is $15,000. So I can get $15,000 added to my asset account. All right, it's not balanced. I need a second entry. I'm just going to go ahead and get a bunch of these ready for later. Drag them down. So what balance is this? All right, I didn't get a bill. I was given this for free. This is actually what we would call startup or seed capital. All right, so my seed money or my additional paid-in capital is something that the owners were investing from their own pocket into the company. All right, so this is going to actually increase my equity. One other way to think about equity is how much money do you now owe your owners, right? Maybe you don't really owe it to them, but they put it there, so it technically belongs to them. So the people who gave us our factory, we owe $15,000 to now. That increased my net worth, my equity by 15,000. All right, we are now, all right, if we look at our total equity, right, in the positive. We now have a positive net worth. All right, so that, oh, I don't want all of these as 1, 2, 3s. I would rather have them all as 1s for January. All right, now I also gained agriculture RMUs and FIUs. So again, agriculture, we'll start with the RMUs. I'm gaining this asset, and the price info sheet tells me how much they're worth. Well, actually, all RMUs are 300 and all FIUs are 500. So we'll focus on these whenever we're recording RMUs or FIUs as assets in our ledger. We can record our purchase price of them differently, but the actual account starting with 1, we're only going to have as 300s or 500s. So I gained 2 agriculture RMUs. In my summary sheet, I have 2 agriculture RMUs. So that's going to be 300 times 2 is $600 worth of RMUs. And I'm going to balance that just like before with my seed money or my additional paid-in capital. They gifted it to me. I didn't have to work for it, and I was given it. And one final agriculture FIU worth $500, and we need seed money to balance that at 500 as well. All right, that's just for my agriculture. I have got to do all of that again for my commerce. All right, if you didn't do one of each, it's going to be a bit shorter. If I did all agriculture, I could just double all those numbers. All right, but since I have commerce, all right, I need to figure out how much a commerce factory costs. 2,500. Sorry, that's fixed expense. 2,000 is my standard factory construction cost. It's book worth. So I'm also given a commerce standard factory worth 25,000, and that's going to be balanced by my seed money, and I'm given commerce RMUs worth 600, and that's balanced by seed money again. And we've got our commerce FIUs worth, we got one of them, you don't believe me, look at the summary sheet. One of them, its book worth is going to be 500 for all FIUs. So we record it at 500, and that's going to be our seed money again, this gift, this equity. All right, and we're all balanced. Then we can start thinking about what additional buildings we constructed. Our standard factory for agriculture and our standard factory for commerce. These ones aren't gifts. I'm going to spend cash to build these, but I will start with them immediately. So I don't need to worry about any future asset accounts receivable. All right, so I got a little bit trigger happy with all of those. I'm now moving on to my startup. These aren't the gifts, these are the ones that I purchased. And according to my summary sheet that I have here, oops, we don't want the 1s and 2s, so we will copy and paste instead of drag down. What did I start with? I started with 1 agriculture. Maybe we'll start with our warehouse capacity being a bit higher too. Maybe we'll do 5 of those upgrades. And yeah, why not give ourselves 4 of these? All right, and it automatically told me how much that's going to cost. I just have to turn those costs into my assets in my ledger. So I'll start with my agriculture standard factory. I'm just getting 1 of them, and I already know that it costs 15,000 from before. But I'm going to balance it with cash instead of this gift. I'm paying for this out of the money that I got from my loan. All right, and I also have these agriculture warehouse upgrades or an agriculture expansion, and the total cost for that was 1,200 or 12,500. 12,500. And again, I pay for that with cash. All right, that takes care of my agriculture startup costs. I'm so close to being done the pre-start plan and wrapping up this video. The next thing though is my commerce. So commerce standard factory cost me 25,000. 25,000 of cash. And I built also a commerce warehouse expansion, a commerce expansion that was valued at 14,000 from there. And we're going to balance that with cash. So what we're doing when we debit these assets is we're gaining that building, and when we credit our cash, when we credit our cash, that means that we're losing this cash. So really what's happening is I'm gaining a factory, losing cash, gaining warehouses, losing cash. That's the debit and the credits of these asset accounts. All right, and as we go, it's always nice to keep track of our chart of accounts over here. So every building that I successfully purchased or was gifted now appears here. My expansions are looking good here. Still have that loan to pay off, and I still have this equity from my investors paid in capital. All right, that is actually it for our first video on our startup costs. If you have extra warehouses or extra costs in your pre-start plan, make sure to include them. All right, if you built autos or tech, all right, all of that belongs in this startup section of your ledger. And then in the next video, we're going to start looking at what happens when you get into the simulation, running through a month of the actual simulation. This is all just pre-simulation, startup, pre-start plan ledgers. All right, thanks for watching. We will see you later.